Welcome to the Daily Brief, where I'll go over the highlights for the action in the market for Monday, December 19th, and then we'll see how things are looking for Tuesday, December 20th. We had another down day, just like last Thursday was a down day, and then Friday was a continuation of Thursday. Well, Monday was just another continuation of Friday. We are still getting a little extreme in the short term as far as going down too far too fast, but it doesn't mean that we've necessarily bottomed, but it might slow down. We may get some kind of a bounce out of that, but we'll just have to see how things go in Tuesday's session. But things are pretty negative now, and they've switched over and we're going lower and lower. And this seems more uniform right now. We're seeing all of our charts pretty much going down altogether. So things have really taken on a more negative slant, but we're not in a trending environment yet. The ADX continues to fall, so we're still chopping more or less sideways according to that indicator, if you use that to determine trending from non-trending environments. Let's go back and talk about what happened. Right at the open, we had a lower open, and we went down below the daily pivot at 38.57. Then what often happens is we rebounded a little bit, but we hit the unchanged level, and that acted as resistance. As the day went on, prices fell to S1 at 38.23, moved sideways for a lot of the day, and then dropped to almost S2. Didn't quite get down to the 37.94 level, but ended up finding support at just above S2 at 3,800. So that's more psychological, and that held in Monday's session. We closed a little bit off of the low. We were down 0.9% with below average volume. We're kind of back into that mode now, and that may continue. You have a lot of folks that are very discouraged with what has happened in 2022. Maybe they've already did what they're going to do this year, and so they're just getting out of the market, going home, and trying to enjoy the Christmas holiday. And that may happen now for the next 1 to 2 weeks, possibly even 3 weeks, until everybody comes back from their respective vacations and tries to decide, okay, what's going to happen. Now, it doesn't mean that we'll always go that way, but around the holidays, we tend to see volume really decrease, and that only makes sense. We're still pretty negative as far as the technicals are concerned, and I have a few charts, a couple of new charts that I'll show you in this video. Because inflation and interest rates, which are also producing growth concerns, both internationally and within the US, that's what the market is fixated on right now. But there's a whole list of geopolitical concerns that I'll go through at the end of the video. Any one of those can always come to the forefront. We have earnings not only on a company by company basis, but what's happening within the stock market itself. The earnings per share concerns as a whole are starting to come into the market and being justification for prices to move lower. And then if we happen to get any Fed speak. So here's what happened. We had the lower open below the pivot, came down, the unchanged level acted as resistance. We fell back down, came down to S1 and danced along this level for quite a while, broke below S1, didn't make it all the way down to S2, and then came up a little bit. And this level right here is the 3,800 level, and then closed a little bit off of the low right before the close of the market. So what are some comments? COVID cases are starting to spread in China. I'm seeing that not only in reports that I read, but I have kind of firsthand knowledge of that because I teach Chinese children English lessons, and I'm hearing a lot of them are saying we're back to online internet classes now. And some parents that I know are battling with COVID. And so it's starting to get a little bad again. The reason I bring that up is because that could have an impact on US companies that do business in China. It could also have an impact on the supply chain issues coming from China over to the US. And then we have this earnings per share as well as valuation. Those concerns seem to be the scenario that the market is latching onto currently. The VIX declined on a down day, which is kind of strange. I'm keeping an eye on the VIX. It's been acting a little strange the last few sessions. Usually when we have a down day, the VIX will go up. The dollar was down and interest rates were up. So the dollar declining may have given some support to stocks, but that didn't happen. But then interest rates going up provided some headwinds. And on a short-term basis, we still have our moving average study going back 20 periods. That is extreme negative or in oversold territory. The rate of change going back 5 periods, as well as the McClellan oscillator, the force index, that's new on this list. That's getting a little extreme. And the PMOs that are rising are extreme, stochastics, Stoch RSI, and the Williams percent are. So our list continues to expand on a short-term basis, saying that we may be going down too far too fast. Intermediate term, not really showing any extreme negative readings other than the CCI, the 14 period, and the 20 period. And we still have all of our yield curves that are inverted. The 30 to the 5 is getting close, but it's still inverted. Sentiment is now negative. We switched over after Friday's session to more negative stance, showing that there's fear in the market. That continued in Monday's session. And we had the NAHB Housing Market Index that came in at 31, lower than the expected 34. The last time we got this report, it came out at 33. The trend is still negative and weakening. The ADX continues to decline, and we're below 20 with that indicator. Our bias continues to be negative, as does our momentum. Here's an updated chart as of last Thursday showing the green down here. This is going back to 2006 to 2008, where this is suggesting that we might see some weakness going forward here. It looked like on the white line, that's what's actually happening, that we may be going against that, but with the action late last week and early this week, we're starting to see some more declines, matching up more with what we're seeing in this chart. So we might see some more weakness going into the end of the year. The VIX, really, it's not going up the way you would expect as we're going down, but this is suggesting, this is just comparing right now with what may happen, where if prices continue to fall, you typically will see the VIX really start to spike up. That's not really happening yet, but that still could happen going forward. Here's the rate of change going back 5 periods, showing that we're getting a little extreme. Here's the equity put call ratio. It did update this time, where on a down day, we saw a decline in the equity put call ratio. Kind of strange. We're getting back more to normal readings on the daily chart. If we go back over 5 periods, back over the last 5 periods, we declined just a little bit, and we're still quite high overall. We're still working on this spike, and in a normal environment, of course, what's normal these days? When this spikes, that would typically mark a bottom in the S&P, and then we would see the VIX continue to decline. We're not seeing that in this. This spiked up, and we pretty much chopped sideways. As we've been going down, there's some days when the VIX, or excuse me, the equity put call ratio really declines. Other days when it goes down, when we have a down day. And this is just measuring the number of puts that are purchased versus the calls. Here's our trend showing that we're still below this moving average and declining. So we're in a pretty sideways market. It's kind of hard if you're seeing this as a breakdown out of this sideways action that we've had. You're going, wait a minute, I see a trend here, and that's fine. If you want to try to take advantage of that and you go against what the ADX is suggesting, that's fine. But typically, this has been a fairly good measurement to determine trending from non-trending environments. Here's one that I haven't shown in a while. This is called the Arun, and this just measures buying power against selling pressure, and where the red line really spiked up as the green line is coming down. The green line is buying, the red line is selling, and what it does down below is this is an oscillator that just measures the difference. We had been fairly positive with this indicator. Well, with Monday's action, the selling really shot up, and our oscillator has now dropped down below 0. So that has switched to a more negative stance. The BPI, I've been showing this a lot lately, where we spiked right here, and you might say that this is a head and shoulders top. We'll see. But it's really been coming down, and we've dropped below 50. So this is turning more negative currently. Then we have our PMO studies, where The PMOs that are rising, this is starting to get extreme negative. The buy signals are starting to get extreme negative, and we're finally starting to roll over below this extreme positive reading with those PMOs that are above zero. Stochastics, the really short term is extreme and the intermediate term is extreme. The longer term is declining. But again, as I state every time, all of these together are still part of the short term, and we're just subdividing the short term time frame. Here's our moving average study, starting to get extreme with our 20 period, declining with the 50 and the 200. McClellan oscillator, it was down after Thursday and Friday. It's continuing to decline, and we don't really know if this has hit a bottom yet or not. It's just getting into an extreme reading. Here's our double and triple exponential moving averages. We're now down below this anchored moving average going back to the COVID low. So that is more negative. This is a chart I haven't shown in a while. This is a built-in system called the go, no go. When it says go, we see lots of blue bars here, and that means buy. When no go, assuming that you only do long positions, that means either sell what you have or definitely don't go long at that point. According to this system, we just generated a new no-go on this chart. So that's negative. Looking at our daily chart, we've broken down below this S1 level now. We're just right below that. So we're turning more negative. As we came up to this 4,100 level just last week, we hit this upward part of this trend, and we've been just declining ever since then. Are we going to continue to fall from here? Are we going to go sideways, or will we see some kind of a bounce going forward? Looking down below, you can see where volume really dropped off. There's our moving average tree. We're dropping below the 50-period moving average and staying below that now. So that is more negative. New highs, new lows. We're seeing where new lows are starting to expand. So our 5-period is declining and our 10-period is also going down. Swindling trading oscillator also going down based on price and volume, and not necessarily extreme right now. Our fib levels, I tried to update these a little bit, extending the lines over. We're breaking through a lot of support. We have another level right in here at about the 38.06 to 07 level. And I hand draw these fib levels. They're not automatically put on here. So I may get some of these numbers wrong a bit. You kind of have to eyeball it. But we have this other fib level. We're still hanging out just slightly above that at 38.17. If we break below that, that could be more negative. And this is a short-term Feb level going back to the August high to the October low. That's the red lines. And then the blue lines go from the September high to the October low. And we just try to keep up with what are the retracement levels that can act as support or resistance. Here's a longer-term Fib level, and we have our two Fibonacci lines right on top of each other. I extended this line over a little bit, and we're starting to break down below that. That was at the 38.25 to 26 level. Well, we're now at 38.17. So we're starting to see some breakdown in support on this chart. Weekly, we're also right at some levels. And again, the thickness of the lines and drawing them and eyeballing it, you may come up with slightly different answers for this, but we're just a little bit above or at support right now on the weekly chart. This is the 200-week moving average, and this is going to be a real line in the sand if we end up coming down to this level. Right now it's at about 36.63 or so to round up, and if we come down here and break below that, that could really shift things into a much more negative environment. So I'll be keeping an eye on that. Here's our trend channel, where we're right about in the midpoint, and we're starting to break down below that as well. The Dow is still above both its moving averages, the 50 and the 200, and as long as they're above this, we're going to see this golden cross. But is it going to be a fake signal or a false signal? If we start to break down these moving averages, that will turn this signal back down and look much more negative. So what's our outlook for Tuesday? The technicals are negative and still becoming short-term oversold. I said that for Monday's video. it's pretty much the same story. We have housing starts coming out on Tuesday and building permits. Both of these together tend to be pretty good leading indicators as far as the housing market is concerned. And then the whole list of geopolitical events. The market is still fixated on the inflation and interest rates. And then this slowing of earnings, not only on a micro basis, company by company, but a macro basis for the whole stock market together. And then if we get any Fed speak, there's the debate going back and forth. Are we in a recession? Is it stagflation with really high interest rates and very minimal growth, if not even a decline in the growth? So there's lots of things to be concerned about right now as far as the market is concerned. Not really going with the down scenario, although you could if you're much more aggressive. But because we're hitting that oversold condition and our ADX is still suggesting that we're not trending, you might be a little leery of that. We really can't go with the positive yet unless you're an ultimate risk taker and want to try to grab a hold of the short-term oversold condition, and we may get some kind of a bounce out of that. But everything is really pushing over negative. Our scenarios are deteriorating. Our sector rotation continues to break down. Our setups, there's a few of them that if we continue to decline, they may generate new signals, meaning extreme negative signals, which quite often mark a bottom in the market, but we're kind of far away from that right now. The technicals are still decidedly negative. We're starting to lose moving averages, pivot levels, fib retracements, support, all of that. So we're still kind of going with this sideways because of the ADX. It's below 20 and the red line's on top, so it is negative. So our conclusion, the S&P is negative and still becoming more oversold in the short term. Intermediate term, it's still slightly oversold. If we get a real move to the downside, that may shift some of our charts. But right now, it's more orderly. It's not really registering as an extreme negative reading. Long term, we're still negative because we're below the 200-day simple moving average. The longer we stay below that, any improvements that we were seeing a few weeks ago, those seem to be dissipating. So thank you. Have a wonderful day on Tuesday. This will be the only video that I produce and upload. So have a really good day, and I'll talk to you in the next video.